I knew two men, both graduated from Harvard MBA in 1995. Same class, same grades, same potential. In 2000, both came to me for advice. The first one said, Jamie, should I buy this stock? The second one said, Jamie, how should I build this system? Today, in 2025, the first man is living a middle-class life, still worried about retirement. The second man, $300 million net worth, same starting point, completely different outcomes. What was the difference? 7 critical money mistakes. The first man made all of them. The second man made none of them. Today, I'm going to break down those 7 mistakes because these mistakes don't just cost you money, they cost you your life. I'm Jamie Dimon. I've been CEO of JP Morgan Chase for 20 years. I've worked with thousands of people over 40 years, and I've seen this pattern repeat over and over. Smart people, hardworking people, talented people, but they make these 7 mistakes and they stay stuck. Today, you're going to learn what they are, and more importantly, how to avoid them. Let me be clear about something. Success in money is not about intelligence. It's not about education. It's not even about how hard you work. I've met brilliant people who are broke. I've met hardworking people who never get ahead. And I've met people who aren't particularly smart or hardworking, but they're wealthy. What's the difference? The difference is in the decisions they make, the patterns they follow, the mistakes they avoid. Unsuccessful people make the same mistakes over and over. It's like they're following a playbook for failure. Meanwhile, successful people follow a completely different playbook. Over my 40 years in banking, I've had a unique position. I've seen both playbooks up close. I've financed billionaires. I've rejected broke people. I've watched fortunes being made and fortunes being lost. And the patterns are crystal clear. Today, I'm going to show you the 7 mistakes from the failure playbook, not to shame anyone, not to judge, but to help you recognize them in your own life. Because most people don't even know they're making these mistakes. They think they're doing the right thing. But these mistakes compound over time. And before you know it, 20 years have passed and you're stuck. This is the most common mistake I see. And it's devastating. People obsess over their salary, their hourly rate, their paycheck. I need a raise. I need a promotion. I need a higher paying job. All focused on income. But here's what they don't understand. Income doesn't make you wealthy. Assets make you wealthy. Let me give you a real example from my career. In 2005, I met 2 people. Both were 35 years old. Person A was a lawyer at a top firm, making $350,000 a year. Impressive income, right? But when I looked at his financials, he was renting a luxury apartment, $5,000 a month, leasing a BMW, $1,200 a month, designer clothes, expensive restaurants, luxury vacations, savings, $50,000, investments, almost nothing, high income, no wealth. Person B was a teacher, making $65,000 a year, much lower income. But look at her financials. Owned a modest condo, bought in 2000, now paid off. Drove a 10-year-old Honda. Lived simply. Had been investing $1,500 2 months for 10 years in index funds. Net worth, $380,000. Lower income, real wealth. Fast forward to 2025, 20 years later, person A, still making good money as a lawyer, but net worth $400,000 at 55 years old. Terrified of retirement. Person B, retired early at 50. Net worth, $2.8 million. Living off investment income. See the difference? When you focus on income, you fall into lifestyle inflation. You earn more, you spend more, you get a raise, you upgrade your lifestyle. It never ends. But when you focus on wealth, you ask different questions. Does this purchase build assets or just create expenses? Will this be worth more or less in 10 years? At JP Morgan, when I evaluate someone for a major loan, you know what I look at? Not their income, their balance sheet. Because income can disappear overnight. You lose your job, the income stops. But assets generate income. Assets appreciate. Assets work for you even when you're sleeping. Stop asking, how can I earn more? Start asking, how can I build more assets? Every month, before you spend a dollar, ask, how much of my income am I converting into assets this month? I recommend a minimum of 20%. If you earn $5,000 a month, $1,000 should go into assets, stocks, real estate, business equity, something that will grow, not a nicer car, not a bigger apartment. Assets, this mistake destroys more wealth than almost anything else. People buy things they think are investments, but they're actually liabilities. Let me define these terms clearly. Something that puts money in your pocket, something that takes money out of your pocket. Simple, right? But people get confused. They think their house is an asset. Their car is an asset. Their boat is an asset. Wrong. If it's not generating income, it's a liability. Let me tell you about a client. I'll call him Mark. Mark came to me in 2010. He was proud. Jamie, I'm doing great. Look at my assets. He showed me $800,000 house, $150,000 in 2 cars, Mercedes and Range Rover, $300,000 vacation home, $50,000 boat. I have $1.3 million in assets. He said, I looked at him and said, Mark, you don't have $1.3 million in assets. You have $1.3 million in liabilities. He was confused. What do you mean? These are things I own. I explained the house, $4,000, month mortgage, $800, month property tax, $300, month insurance, $200, month maintenance, total $5,300 month OUT of his pocket. That's $63,600 per year. Liability, the cars, $2,500 month in payments, $400 month insurance, $300 month gas and maintenance, total $3,200 month OUT. Liability, vacation home, $2,000 month mortgage, plus $1,000 month in carrying costs, used 3 weeks per year. Liability, $1,200 month's flip fees, insurance, maintenance, used maybe 10 times a year. Liability, total money OUT every month from these assets, $11,700. That's $140,400 per year. And Mark's income, $180,000 per year after taxes. He was spending 78% of his income just maintaining his assets. Now, compare this to someone I know. I'll call her Sarah. Sarah had different assets. A rental property that generated $1,800 a month, positive cash flow after all expenses, a portfolio of dividend stocks generating $2,000 a month, a small stake in a business generating $1,500 a month. Her assets were putting $5,300 a month into her pocket, $63,600 per year. Who do you think is wealthier? Sarah, by miles. The key insight, real assets generate income. Everything else is a liability dressed up as an asset. Before you buy anything expensive, ask, will this generate income or create expenses? If it creates expenses, it's a liability. You can still buy it if you want, but be honest about what it is and prioritize buying real assets, things that pay you. This is a fundamental mindset error. Most people think I work, I earn money, I spend it, I work more. It's a treadmill. You're always running, never getting ahead. But wealthy people think differently. I work, I earn money, I invest it. It works for me. I earn more without working. Let me illustrate with 2 career paths I've observed. Path A, D, high earning employee. John is a successful executive. He climbs the corporate ladder. By age 45, he's making $500,000 a year. Sounds great, right? But here's his pattern. He works 70 hours a week. All his income comes from his job. He spends most of what he earns. He saves some, but not systematically. His time is completely consumed by work. At 55, he's burned out. He wants to retire, but he can't because his only source of income is his job. If he stops working, the money stops. He's trapped. Golden handcuffs. Path B shit, the wealth builder. Lisa takes a different approach. She also works hard, but she earns less, maybe $200,000 a year. But here's what she does differently. Year 1 to 5, she lives on $80,000, invests $120,000 per year aggressively. Year 5, she buys her first rental property with accumulated down payment. Year 7, she buys a second rental property. Her investments and rentals are generating $40,000 year passive income. Year 15, Passive income is up to $120,000 a year, and passive income exceeds her living expenses. At age 45, Lisa is financially independent. She can choose to work or not. Her investments work for her, same 20-year time frame. One person is trapped, one is free. The compound effect. Here's what most people don't understand about making money work for you. It compounds. When you work for money, you trade time for dollars, linear relationship. But when money works for you, it multiplies. Your investments earn returns. Those returns get reinvested and earn more returns. Exponential growth. Let me show you the math. Scenario one, working for money. You earn $100,000 a year. You work for 30 years, total earned $3 million. Scenario two, money working for you. You earn $100,000 a year. You invest $30,000 a year for 30 years. Average return, 8% per year. Total value after 30 years, $3.4 million. But here's the key. In scenario one, you worked for 30 years. In scenario two, you worked for maybe 15 to 20 years and then lived off investment income. The fix. Step one, pay yourself first. Every paycheck, 20-30% goes straight to investments. Automate it. Step two, build your investment portfolio systematically. Index funds, rental properties, business ownership. Step three, reinvest all returns. Don't touch dividends. Don't spend capital gains. Let it compound. Step four, calculate your freedom number, how much passive income you need to cover living expenses. Step five, track progress. Watch as your passive income grows month by month, year by year. This mistake kills potential before it even has a chance to grow. I see it constantly. People with great ideas, great ambition, great potential, but they wait. They wait for the right time. They wait for permission. They wait for certainty, and they end up waiting forever. In 2009, right after the financial crisis, two of my friends both had the same idea: buy real estate while it was cheap. Asterisk, asterisk, friend A, the waiter. Asterisk, asterisk, he saw the opportunity. Properties were down 40-50%. It was obvious. But he said, I should wait until the market stabilizes. What if it goes lower? I need to be sure this is the bottom. Let me see what the experts say. He analyzed, he researched, he waited. By 2012, he was still waiting. Prices had recovered 30%. It's too late now, he said. By 2015, prices were back to 2006 levels. I missed it, he said. By 2020, properties he looked at in 2009 had doubled. If only I had acted, he said. He never bought. He's still renting today. Friend B, the risk taker, he saw the same opportunity, but he acted differently. He said, I don't know if this is the bottom, but it's close enough. Even if it drops another 10%, I'm buying at a massive discount. I'll never have perfect information, so I'll act with good information. In 2009 to 2010, he bought 3 properties, scraped together down payments, took on mortgages. It was scary. Today, those 3 properties are worth $2.4 million. He paid $720,000 total. Net gain, $1.68 million, plus rental income for 15 years. Why do people wait? Fear. Fear of being wrong. Fear of losing money. Fear of looking stupid. But here's what they don't realize. Waiting is also a risk. In fact, it's often the bigger risk. What calculated risk actually means. I'm not telling you to be reckless. I'm saying take calculated risks. Here's what that means. 1, do your research, understand what you're getting into, know the upside and downside. 2, have a margin of safety. Don't bet everything, keep reserves. 3, act despite uncertainty. 80% certainty is enough. Waiting for 100% means you've waited too long. 4, learn from results. If it doesn't work, extract lessons and move on. Define your criteria. Write down what makes an opportunity worth pursuing. Use the regret minimization framework. At age 80, which will you regret more, trying and failing or never trying? Set action deadlines. Start small and scale up. This is perhaps the most insidious mistake because it feels good in the short term but destroys wealth long term. People want to look successful more than they want to be successful. Case study 1, looking rich. David is a doctor, makes $400,000 a year. Here's his lifestyle. $2.5 million house in the best neighborhood. Tesla Model X, $100,000. Rolex collection, $150,000. Designer wardrobe. Exclusive country club membership. Luxury vacations. Dubai, Maldives, Europe, private school for kids, $60,000 a. Everyone thinks David is rich. He looks rich, but his balance sheet, net worth, $300,000 at age 48. Mostly home equity, almost no liquid investments. Credit card balances, he rolls over, stressed about money constantly. David looks rich. But he's broke with a nice car. Case study 2, being rich. Susan is also a doctor, makes about the same, $380,000 a year. Here's her lifestyle, $600,000 house in a good, not fancy neighborhood. 5-year-old Honda Accord. No luxury watches or designer clothes, vacations or camping trips with the kids. Public school for kids, modest lifestyle overall. People don't think Susan is wealthy. She doesn't look rich, but her balance sheet, net worth $4.2 million at age 47, $2.8 million in investment accounts, $900,000 in paid off rental properties, $500,000 home equity, zero debt except rental mortgages. Susan I.S. rich, really rich. But you never know from looking at her. In 20-year projection, David at 68, still working because he can't afford to retire. Net worth, maybe $1.5 million, if lucky. Still maintaining expensive lifestyle. Anxious about retirement. Susan, at 67, retired at 551, 2 years of freedom, net worth $12 plus million, living off investment income comfortably, zero financial stress. I work with billionaires, real billionaires. Most of them don't look rich. Warren Buffett lives in the same house he bought in 1958 for $31,500. Mark Zuckerberg wears the same gray t-shirt every day because they understand money spent on showing off is money that can't compound. They'd rather be rich than look rich. Define your real goals. Financial independence, early retirement, practice stealth wealth. Be wealthy quietly. Calculate the true cost. That $100,000 car invested at 8% for 30 years becomes $1 million. You're not choosing between $100,000 and a car. You're choosing between $1 million and a car. People don't learn about money. They assume someone else will handle it for them. But you need to understand the fundamentals. You can't delegate your financial education. In 2018, a friend, Robert, came to me upset. Jamie, my financial advisor lost me $200,000. What should I do? I asked him to explain what happened. He couldn't. He had no idea what his money was invested in or why he lost money. I just trusted him, Robert said. The advisor had put him in extremely risky option strategies. The advisor was making commissions. Robert was taking all the risk. Because Robert knew nothing about investing, he couldn't ask the right questions or spot the red flags. Contrast with Maria. Maria also uses a financial advisor, but she's educated. She understands asset allocation, tax-efficient investing, expense ratios, diversification, risk management. When her advisor makes recommendations, she asks, why this fund versus that one? What's the expense ratio? How does this fit with my overall allocation? What's the tax implication? Her advisor knows he can't BS her. Maria's portfolio has grown consistently. What you must understand, 1, how compound interest works, the most powerful force in wealth building. 2, asset allocation, stocks for growth, bonds for stability, cash for liquidity, real estate for income. 3, tax efficiency, tax advantage accounts, 401k, IRA, Roth, tax loss harvesting. 4, fees and costs. A 1% fee difference equals 30% less wealth over 30 years. 5, diversification. When to diversify versus concentrate. 6, behavioral finance. Why emotions destroy returns. How to stay disciplined. This is not complicated. You can learn this in 20 to 40 hours of focused study. Month 1 to 2, read The Simple Path to Wealth by J.L. Collins and Common Sense Investing by John Bogle. Month 3 to 4, learn about 401k, IRA, Roth IRA, taxable accounts, understand tax implications. Month 5 to 6, read A Random Walk Down Wall Street and The Psychology of Money. Ongoing, read Warren Buffett's annual letters. Review your portfolio quarterly. Then, after you're educated, interview multiple advisors, ask tough questions, maintain oversight. Never blindly trust anyone with your money. This is the mistake that ties everything together. It's the root cause of almost every other mistake. People want quick results, fast money, immediate gratification. In 2005, two cousins, both 25 years old, came to me for advice. Cousin A, the short-term thinker, he wanted to get rich quick. 2006, day trading, lost $15,000. 2007, tried to flip houses, got caught in the 2008 crash, lost $50,000. 2010, got into penny stocks, lost $10,000. 2013, multiple businesses, none succeeded. 2017, went heavy into crypto at the peak, lost $40,000 in 2018 crash. 2021, meme stocks, lost $25,000. By 2025, at age 45, his net worth $80,000. 20 years of hustling, nothing to show for it. Cousin B, the long-term thinker. She had a different approach. Boring, disciplined, patient. Her plan, max out 401k every year. Invest in low-cost index funds. Buy one rental property every 5 years. Never sell unless absolutely necessary. Stay the course. Here's what happened. 2005 to 2025. Invested $19,500. Year in 401k. Total contributions $390,000. With employer match and compound growth. $1.2 million. Plus 2007, first rental, $200,000, now worth $450,000. 2012, second rental, $180,000, now worth $420,000. 2017, third rental, $250,000, now worth $400,000. Total net worth is $3.1 million. Same 20-year time frame. The patient one is 40x wealthier. Why short-term thinking fails? 1, transaction costs. Every time you buy and sell, you pay fees, taxes, spreads. 2, emotional decisions, fear, greed, FOMO, lead to terrible timing. 3, missing compound growth. The real wealth comes from decades of compounding. 4, opportunity cost. While chasing the next thing, you miss reliable wealth builders. The math, $10,000 invested in S&P, $500 at 10% average return. After 10 years, $25,937. After 20 years, $67,275. After 30 years, $174,494. After 40 years, $452,593. The magic happens in years 20 to 40. But most people quit too soon. 1, define your 10 plus year timeline. Every investment should have minimum 10-year horizon. 2, automate your investing. Set up automatic monthly investments. 3, ignore the noise. Stop checking portfolio daily. Check quarterly at most. 4, embrace volatility. Down markets are opportunities, not reasons to panic. 5, measure success in decades. Judge by 10, 20, 30-year returns, not monthly. 6, have a written plan. Write down your strategy. Stick to it. Remember the 2 Harvard graduates from the beginning? The one with $300 million and the one still worried about retirement? The difference wasn't intelligence. It wasn't education. It wasn't luck. It was these 7 decisions. 1, they focused on wealth, not just income. 2, they bought assets, not liabilities. 3, they made money work for them. 4, they took calculated risks. 5, they focused on being rich, not looking rich. 6, they educated themselves financially. 7, they thought long-term. One person made all 7 mistakes. One person made none of them. Over 25 years, these small differences compound into massive outcomes Now you know what they are. You can keep making these mistakes. Most people do. It's easy, it's comfortable, or you can choose a different path. Your financial future isn't determined by where you start, it's determined by the patterns you follow, the decisions you make, the mistakes you avoid. Choose the right playbook. Avoid these 7 mistakes. Build real wealth. The next 20 years are going to pass whether you do this or not. Make them count.